Hello everyone, Steve Lynch here with Discover Options at OptionView. Welcome to this presentation of several different timing reports. This will be for July 7th on Friday, getting ready for Monday. Let's see, on the 10th, presented material is for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So today we have three different timing reports for advanced options traders. The Condor Butterfly timing report for the S&P 500 for the same market, the bull put spread timing report for those that like to lean things a little bullish, and then also the directional likelihood report for those more statistically oriented. Now before we get into those reports, want to make you aware that you can get a free ebook co-authored by myself and Jim Graham, Simple Steps to Options Trading Success. You could just click the link, give us your information, we'll get that free ebook out to you. Also, we'd appreciate it if you could subscribe. Just click on the subscribe button and you'll get notified then when we have new recordings come out. Okay, now without further ado, let's get to the current market condition for the S&P 500. We define market condition in three ways: price action, trend, and then the overbought, oversold levels with stochastics. And price action, we see that Thursday was a downswing day with a lower high and lower low. It actually dipped below the 50-day moving average, came back up, and was an upswing bar on Friday and finished above the 50-day moving average, which defines our trend as being upward, long-term trend being upward. In terms of the stochastic, the 15-3 stochastic is between 10 and 60, yet we are underneath our percent D, the 3-day moving average of that. All that combines for a unique market condition that's occurred roughly 64 times since January of 2000. Pretty interesting. So with that in mind, with that market condition in mind, let's get to the timing reports, okay? First, we have the Condor Butterfly timing report. So since Jan of 2000, there have been over 4,300 daily closes of the SPX. Now, of these, 65.3% have been favorable bars for selling premium using these strategies, where the actual 21 bar movement turned out to be less than the SIBO skew adjusted implied movement. Okay, we take the VIX and we apply the skew that occurs in the options in the SPX, and we come up with a skew adjusted VIX, and using that we conclude that there's been roughly 65% of the bars have been favorable for doing condors and butters, where the actual movement was less than that implied by the VIX, coming from the options prices. Now, also during that time, our current market condition, as I told you, has occurred 64 times. Now, of those 64, 59.4% have turned out to have been similarly favorable. Now, that's less than the benchmark of the market going back to Jan of 2000, right? So that means that we have a selling edge that is negative of about 6%. Okay, of the 64 times our market conditions occurred, a lower percentage of those have been favorable than the broad market in general, going back to Jan of 2000. So there's a negative edge right now for condors and butters. Does it mean that if you trade a butter or condor that that you'll lose? No. It just means that there's a higher likelihood that you'll encounter rough waters if the past holds true from 64 times that we've checked. Okay, so that's what that means. Doesn't mean you'll automatically lose. It just means that there's a higher likelihood that we'll have rough waters, a greater likelihood than normal. Okay, now let's go to the bull put spread timing report. This is for those that like to trade, sell out of the money put premium, and maybe do it either naked, or you could cover it with a longer, a long contract and the further out of the money puts and create a credit spread. We're presupposing that you're going to sell these at a standard deviation out of the money, maybe 30 days out. Okay, so with that in mind, here's how the report goes. Okay, since Jan of 2000, we've had 4,347 daily closes of the SPX. Now, of those 43, 47 or something. Okay, I didn't change that. Yep, roughly 4,350. 82.8% have been favorable for selling out of the money put premium a standard deviation away, where the actual 21 bar downside movement turned out to have been less than the CBOE skew adjusted implied movement to the downside. Okay, so 82. So you could flip a coin continually in the SPX trading this way. 82.8% of the time you would win. Okay, that's the benchmark. Also during that time, as we showed you, our current conditions occurred 64 times. Now look at this. Out of the 64 occurrences, 79.9% of the bars turned out to have been favorable. That's less than the benchmark, okay, of 82.8. So that means that we have a selling edge that is negative 3.1 for bull put spreads. Does it mean you'll lose? No. It just simply means there's a greater chance than normal that the market will move against you and hit your short strike if it is set up exactly one standard deviation away to the downside 30 days out. That's what that means. Okay. And so statistically, it's more likely than normal that we'll end up having an unfavorable condition for selling out of the money put premium. I'm just reading the last line there. Okay, so that's the bull put spread timing report. Let's go to the likelihood report. What we're doing here is exploring distributions, price distribution. The question on the table is, given our current market condition, is the market likely to go up, down, or wobble around and stay around and and do nothing? Okay, given our current market condition based on the past, what is the market likely to do? Well, how do we define that? And we do that using distribution bands, where we take our current close, we go out a standard deviation to the upside and the downside, and we do these in 5, 10, and 15-day increments. And we just simply ask, in the past, how often has the market gone up and hit the one standard deviation to the upside, 5, 10, or 15, and to the downside, 5, 10, or 15. Let me show you what I'm talking about here. Okay, here's the close. This is for a while back in the SPX. Here is a 5-day, one standard deviation price band right up here. Here's the one to the downside down here. One thing you'll notice is that I have skewed these distances to reflect the CBOE skew adjusted VIX, so that the out of the money calls, which have a lower implied volatility, they're being recognized, as opposed to for the lower distance here, shorter distance, as opposed to the out of the money put implied volatility, which is higher than the calls. And so that's why the downside is farther away than the upside. Got it? Okay, so the question here is over the next 5 days, will price go up and hit the upper 5-day band, go down and hit the lower 5-day band, or wobble around? And so what I've done is, let me show you. I've done this for both the 10 and the 15-day price bands. And when we go out in the past and look at the last 4,351 closes, we can see that the upper 5-day band was struck 21.4% of the time. The upper 10-day band was struck 15.9%. The upper 15-day band was struck 14.9%. Now on the lower side, the lower band, 5-day, 16.6, 16.8, 19.6. So this is the benchmark. Okay, now of those, here we have 66. Of the 66 occurrences of our current market condition, we can see that of those 66, price hit the upper 5-day band, 24.2, which is higher than the benchmark of 21.4. That's why we have a blue number there. It hit the upper 10-day band, little bit higher, not much. It hit the upper 15-day band a bit higher, almost 5% more. On the lower side, it hit the lower band less often, hit the lower 10-day band less often, and the 15 was about a wash. So what does this say? Okay, if you had to guess of a direction and a likelihood, you would take note that all three of the bands to the upside were struck a little bit more often, and on the downside they were struck a little bit less often. So this speaks to a slight bullish bias to the upside. You see that? Okay, now I did divide this out in terms of what about the cases where price exceeds Friday's high. Of those instances where the previous day's high was exceeded, that happened 31 times. Of those 31 times, 5 of the 6 bands were struck less often, speaking to a lower market volatility in general. The lower 15 was struck a bit more often there. Now, when price exceeded the previous day's low, like if Friday's low gets exceeded, well, that happened 33 times. And there you can see the bullish bias really coming through in that case. So, whether we have 2 of the bands getting struck significantly more often and the bearish bands getting struck less often across the board. Okay, so this is the likelihood report. It will make a difference if price goes above Friday's high or below Friday's low in terms of the statistical likelihood. But again, these are just likelihoods. The market is the market, but I think hopefully this will give you some good information in your decision making come Monday morning. I'm Steve Lentz with Discover Options. Thank you for joining us today. Bye-bye.